industry and obviously that ecosystem of the ASX. I think off the back of that, it's important to acknowledge that we have got a very strong reputation, not just with our clients, but with our regulators and our partners. So you would have seen that we would have taken on a very leading position in regard to the CHESS replacement. And David's going to talk about that, and Tony will talk about the impacts of that in the finances. But we do have this very strong relationship. And the reason why it's important to have that strong relationship is because we want to operate at the highest level. Our customers expect that, governments expect that, and most importantly, I think shareholders and obviously the board expect that as well. So supporting all of that, we've now got $145 billion of assets, and we're one of the largest platforms. I mean, that is a huge amount of responsibility, and we take that on obviously seriously. We've got a really unique opportunity, and that unique opportunity comes about because of this relationship with customers. And our customers definitely are telling us both every day that they want more products and services, but we continue to engage with them on longer terms. So we've been re-signing customers, and most importantly, we've been gaining new customers. And I think the other thing is that we're not losing the customers that we want to retain. So listen, we've got a clear long-term strategy. We've got critical mass in our core capability now, but the focus really for us has got to be able to turn that into profitability. So we're now really driving towards how do we consolidate platforms? How do we make sure that these products and services that we provide actually return obviously a profitable return to our shareholders? So that's really the focus of the team. So we've got the core business. So that's about consolidation. That's about getting on a pathway to profitability. And we've got these growth opportunities to add value and to drive further margin. So listen, I think the first part's been achieved. We've really got the Pershing acquisition down. I've been very pleased around that. I think most other organisations would have stepped away from such a large integration. That's a big tick. I feel very comfortable about the operating environment that we're operating in. We've got a strong cash balance, which has obviously come out of the acquisition. So that's been able to fund the growth. And then the next thing is that we're well in train around adding value to our customers. And most importantly, we need to start to drive value for our shareholders. So we've got the cash platform of Transact One, which is in early days, but we're very pleased about the interactions there. And we've got FX that Dave will talk about. We've got PAS and managed accounts. So listen, overall, I'm pleased about where we are strategically. Obviously, that the financials have been more difficult, but we've got a plan by which we're going to keep on driving costs out and consolidation, which we'll talk about. So listen, just off that, I'm going to hand over to David, and then we're going to go through some of the core numbers that Tony will run through.
Righto, thanks very much, David. And yes, look, we have received some questions from shareholders over the last couple of weeks. We hope to answer most of those questions today, and Tony will run through a balance sheet, the financial performance, and some of what the outlook is. It's certainly, if there are more questions and questions that we don't answer today, please hold out to the end. We'll have a dedicated Q&A session to answer any questions that you don't think have been addressed through this presentation. So Tony, over to you for FY23 results.
Thanks, David. So firstly, just wanted to give a little bit of context, and David's given a little bit of that already. Two things to talk about here. One, we are a transactional business and transaction volume is down considerably across the market. The ASX market is down over 15%, 16% on the year. We are down 15% transaction volume in the year, but we have actually outperformed a number of our peers. Our peer group of clearing brokers, which includes people like Bell Potter, Open Markets, AussieX, Wealth Hub, NAB, that's down 20%. And ComSec, which is the predominant retail stockbroker, is actually down 30%. Secondly, the CHESS replacement program. Now, David will talk about that in more detail later, but there are some very hard financial numbers associated with this, which have impacted our financial statements. The first is we had, over the years, been doing an awful lot of development work to build into the new CHESS replacement solution, which is no longer happening. So we had an asset of $2.5 million of software development, which we've had to write off this year. And secondly, we run 2 operational and technology platforms since the Pershing acquisition. Were it not for the uncertainty around CHESS replacements, we may have changed that by now. And that cost us over $3 million a year each. David will talk about that in detail. So they're the 2 major headwinds that we've had. In terms of a bit of a scorecard, the main measures that we look at as a business, encouragingly, our funds under administration on CHESS, which are our clients' assets, are actually up from 145 billion to 130 billion, and that's despite market falls during that time. And that's because we continue to bring on customers, and some of our customers continue to grow. Now, they're growing in assets and clients, but unfortunately, transaction volume is down. So it doesn't translate into revenue straight away, but hopefully it will at some point. Market turnover, I've mentioned, down for us and for the market. Our core revenue is down from 46 million to 42 million, in line with transactions. I will reconcile these EBITDA numbers on the next slide to the financial statements you've seen. But at a headline level, our actual core business, we have an execution and clearing business, and then we're investing in growth initiatives. Our execution and clearing business lost 3.6 million. We'd prefer it to be profitable, obviously, but it lost 3.6 million. But it actually lost 8.2 million the previous year. So we do continue to improve and drive efficiencies from the acquisition. Cash, we've obviously spent cash. Our cash is $73 million. And just as a comparator, $73 million, that is $5 million more than all of the share capital we've raised in our history. And our growth initiatives on a cash EBITDA level, we've spent 7.3 million last year. Let me go to the next slide to talk a little bit more about that. I've tried here to unpack the loss in the financial statements. So the total loss before tax was about $20 million. If we get to an underlying EBITDA, which is basically taking out the non-cash items, share-based payment is a big number for us, which is basically a calculation, which is a non-cash amount, but it's a P&L item calculated based on the value of our ESOP awards, was 4.3 million, depreciation 3 million. So the underlying EBITDA of almost 13.5 million. Of that, the ASX project write-off was 2.5 million. Core business 3.6 and investment and growth 7.3. So just trying to reconcile those numbers back to the financial statement so it's clear to everyone. And compared to last year, that number was $8 million. So I want to touch quickly on the balance sheet. The balance sheet you see in the financial statements, and this is the way that we need to present it per the auditing standards, the accounting standards, includes the client ledger. So you will see some very large numbers in our financial statements, about 500 million, of which represent an asset and a liability of unsettled trades we have in the market for our clients. So what I've tried to do here is just strip that noise away to say, what is our corporate balance sheet? What does the actual company balance sheet look like? And it looks a bit like this. Cash at bank, $73 million. Receivables, which includes cash margin that we hold at ASX. The other number I want to point out, trade payables and accruables, $50 million, looks like a big number, but actually what that is, it's $20 million we hold in security deposits for our clients, and about $25 million in commission. So we hold our clients' commission and we pay it out to them the following month. And net assets of about $82 million. So that was that's just a snapshot of P&L. Hopefully that's helped to break down the numbers you see in the financial statements. And happy to take more questions later.
So we'll take questions later, but just as a broad overview, if you think about that loss and put it in context, we did acquire a Pershing business 2 years ago that was losing $18 million and consolidated into our core business. So we continue to drive efficiencies there and reduce that loss rate, albeit market volumes are down significantly. And that's in the context of us still having to run dual platforms, and I'm going to talk to this a little bit later. But the fact that we continue to run dual platforms costs the business $5 to $6 million per annum. And I'll talk to that when we get into A380 initiatives a little bit later. Okay, so let's just talk. I want to talk quickly around some of our new initiatives and client wins. We recently won a competitive tender for all of Insignia's, formerly IOOF's trading business. That will contribute, we think, an extra $1 million of revenue. That is yet to kick in. It's a slow process. But essentially what IOOF or Insignia are doing is funneling or concentrating all their execution or platform business through their broker. Their broker is called Bridges, and that all comes through to FinClear. We've increased our leading position in the fintech market by signing Webull. We have been a go-to house for the fintechs. Remembering we have two of the larger Australian homegrown fintechs that run different business models on our platform, being Superhero, that run what we call a custodial capability, and Stake, who run a individual HIN capability. So two very different business models, but we support both those for fintechs on our platform. And now we have Webull coming on board, and in fact, that's another business model where we're acting as a third-party clearer for them and using our APIs. As a sort of brief overview, Webull are the second largest US fintech broker behind Robinhood. So potentially a very large client for us. Additionally, we've re-signed almost all our core and larger third-party clearing clients. Many of them have been up for renewal over the last couple of years. But we've renewed all those contracts with only 2 outstanding, and we are in very advanced stages with those 2. So obviously on the screen there, Ord Minnett, Shaw and Partners, and Wilson's all been re-signed. And we have a couple of the larger outstanding, but we're very confident they will be re-signed in the next month or so. And these are typically for periods of 3 to 5 years. So there has been absolutely negligible churn in that historic Pershing client base. And remember, you know, just to give you an idea of how sticky this client base is, you know, that was a pretty disengaged client base on the Pershing acquisition. You know, that Pershing business was in a little bit of a state of disarray. No one knew what was going to happen to it. Ord Minnett had, in actual fact, terminated their contract and were moving away. But we re-signed Ord Minnett and their subsidiary Baylius that they acquired. So look, it's I think a great testament to the team that we have managed to maintain that client base and actually grow that client base. And we're working very closely with CommSec on what we call the next generation back office platform. And that's a key decision for us. It goes to what we're doing with iBroker. iBroker is our back-end CHESS connectivity engine. And that is coming close to end of life. And so we're contemplating what we're doing around renewing, replacing that, or looking at other partnerships. And that CommSec relationship is obviously important because they're our largest SaaS client on using iBroker. We are mindful of market conditions. As Tony said, revenues are down. Our revenue is down 10%. That is better than the broader market and better than what we're seeing across some of our competitors. But we do have to be mindful that we are in a tough environment. We completed a small restructuring in October, and that will result in a cost savings of, we think, $3 million per annum. But really, when we look at this, our major initiative is what we're calling Project A380, which is our response to the failed CHESS replacement project. And I want to just rewind there and talk about that for a second. That was cancelled this time last year. It's only just in the last week become a little bit clear. It's taken a year for the ASX to come out and tell us what their next approach will be. And their next approach is we're not going to see a new CHESS replacement probably for another 6 or 7 years. They are guiding towards 2028 or 2029. On previous records, I think it'd be fair to say that may even fall out from there. So they're committed to maintaining current CHESS until 2032. But to my mind, we've got to be prepared for really not getting a lot of transparency in replacement for CHESS until back end of this decade and early into the 2030s. What that means is obviously we can't wait. We can't wait for the ASX, and we can't wait for even the construct or knowing what that CHESS replacement's going to look like. We run, as Tony pointed out, 2 back offices at the moment, 2 separate pieces of infrastructure. One is our own infrastructure, and the other we rely on third parties for. That costs us circa $3 million per year to run dual platforms. So A380 is about consolidating those platforms. I get asked quite a lot, well, what's the reference around A380? It's a big double-decker plane, right? And yeah, that's exactly what it is. We run 2 platforms at the moment, and we're consolidating those into one. And so not only do will we get efficiencies from an operational perspective around now only having one operational team to support our business when this is completed, but we also get to retire one of our regulatory clearing bodies, and that will return regulatory capital of around $7 million as well once this project is completed. And we have a timeline around March to April next year for this project. So if you think about the contribution from this, there's an EBITDA contribution both from an infrastructure and teams or efficiency perspective of circa $6 million per annum, plus there's a capital release as well. So this is a very significant project for us, but it's also important for us to get to a single operating platform and be able to demonstrate to our clients that we are becoming a more operationally efficient business rather than servicing one group of clients off one platform and another group of clients off a different platform. So that project has now been initiated. We've spent most of the year planning for this and working out what we needed to do and what the best solution was for that. It's now initiated, and we're confident that this will be delivered at the back end of Q1 next year around March, April. On the revenue side, we continue to build out and deploy on FCX, and I'll talk about FCX in a minute because FCX is a particularly good story for the business. But if you think about where our strategy has been, it's about getting to scale as a business, becoming more efficient as a business, and once we become more efficient and to scale, then looking at cross-selling and delivering more products and services to our clients. And so those cross-sell opportunities across our existing technology products, so TC Advisor is the main one there, and TC is a direct Iris competitor, and we're getting a lot of inquiry from our clients in this sort of depressed revenue environment, particularly where clients are themselves looking for more efficient solutions. So TC is a good opportunity for us in terms of technology. But then on the product side, we've recently made a cash acquisition, a cash platform acquisition, Transact One, and welcomed that team and that business into the business. And obviously that cash capability is important because you only needed to rewind 12 or 18 months ago to see cash was of not great value. With interest rates at close to zero, there wasn't a great opportunity in terms of cash on platform for us. Now there is, and so Transact as an acquisition 3-4 months ago was our foray into recognising that cash as a product is moving or normalising into a more market normal position in terms of interest rate environment, and we think that will remain for some time, and that there is a capability for us to have a cash platform that our clients can use. So it includes both a term deposit platform, but also a managed account scheme as well, or a fund-like structure. And I'll talk to that in the context of FCX as well, because that's actually our first fund structure, unlisted fund structure that we will bring onto FCX. And we're soon to launch our FX and payments platform. So again, talking to our clients and asking our clients, what do you do with other service providers? And what would you do with us if we could enhance our product and service capability? The answers were pretty much threefold. Cash, so we've ticked the box on cash. International equities and FX. Well, we have an international capability for our clients at the moment, but we're not able to capture the margin on the FX transactions. So FX is a major initiative for us, as is looking at capturing more of the international capability for some of our larger clients that still use other offshore brokers. So that's in process. That's in a trial basis at the moment with existing clients, but we think that's a very large and exciting revenue opportunity for the business over the next 12 months. All right, FCX. As you've seen from the financial numbers, FCX is a big investment for us. We continue to invest in FCX as a licensed market and clearinghouse. We recently got some very good news in terms of the RBA going to a public consultation on increasing the financial stability standard requirements, and I'll talk to why that's important a little bit later. But we are very well advanced to becoming the next licensed market in Australia. We think that will be towards the end of Q1 calendar next year. And we've been working very closely with the regulators, with ASIC, with RBA, with Treasury, and others around getting to a position of actually putting our license application in. So I'll just talk to us, a few seconds as to how that works. The application and going through a process takes a long time, but you can't actually put an application in until it's final. That application in the next week or so will be final. And by the way, regulators don't want you to put an application in as final unless they have a very high degree of certainty that it will be approved. So the fact that we are now or shortly about to lodge that final, although still in somewhat draft application is very encouraging, and the engagement that we're getting from both ASIC and RBA is very encouraging on that. I want to talk to a second about the clearing capability, though, because it does go to our core business as well. We initially started off asking for a market license. Now, as most people who know in Australia, and if you get into the detail, understand, if you want to operate a market in Australia, you must have a clearing and settlement facility that underpins that market. In Australia, the only clearing and settlement facility that underpins markets is ASX, Clear and Settle, and CHESS. We obviously didn't want to be underpinned by ASX Clear and Settle because we're using new technology, we're using distributed ledger, and we're atomically in real time having a transaction and a settlement happening at the same time. So we actually asked for an exemption from that, which was denied. But encouragingly, what the regulators asked for was for us to apply for a clearing license. So the ramifications here are quite profound. We have the regulators asking us to apply for a clearing and settlement license that can potentially compete with the other clearing and settlement facility in Australia, being CHESS. So there's a clear competition agenda here that the regulators are catering through, and that's been driven, from politics and from Canberra the whole way down. So we now are in a position where I said we're lodging the market application, but it will include a clearing and settlement facility underpinned by our own atomic capability using distributed ledger to facilitate that. That's actually very exciting. If and when that happens, we will probably be the first licensed market globally within regulatory rails to be running a full atomic distributed ledger capability. There've been announcements from other big exchanges globally, the likes of London Stock Exchange, that are doing a similar thing in private markets as well, but they don't have the technology at this stage to underpin that, and their timeline is potentially back end of 24, if not 25. So I really, the point I want to make here is that we, in terms of where we are positioned, are incredibly well advanced of the globe. We have a capability today, and we are onboarding companies onto FCX today. So a quick snapshot, we have 30 to 50 companies today, either onboarded or in the process of onboarding, including hopefully the first unlisted fund, which is our own. So Transact One, I spoke to that a few minutes ago, where Transact One will be on FCX, we believe, over the coming weeks. And from there, we start to look at alternative assets. So the capability for FCX is first and foremost in unlisted private companies and creating a market and ecosystem for those companies. Secondly, we think there's a large opportunity in unlisted funds, and we continue to have very good engagement on that front. But then thirdly, there's an opportunity into alternate assets, given that FCX has been built as asset class agnostic. So we're quite excited about that. So 30 to 50 companies as of today. We've completed 20 corporate actions or transactions, if you want to think about it that way, at a value of around $40 million. And the value of companies currently sitting on FCX are, we think, in excess of $1 billion of market cap. As I said, our priority has been around building FCX out as a platform capability, working with the regulators to get to that licensed market, and having a clearing and settlement facility that underpins it, and concentrating on unlisted assets, private companies, unlisted funds, and alternative assets. But actually, the challenger status around what's going on with ASX CHESS is very real. As I said before, CHESS, the replacement for CHESS, will not happen for another 7, 8, maybe 9 years or so. The capability for us to build an alternate market for other companies that may want to stay private longer, providing liquidity for those shareholders, or even for their staff through ESOP, or for unlisted funds, or for other assets, is very real. And so this is the first stage for us to deliver this capability for private markets. But the capability for us to deploy this technology across the back end of our listed business is another opportunity that we continue to look at, because really, you know, if you think about the foundations of why we invested in FCX to start with, well, first and foremost, there was a business opportunity. We had clients asking us, we had high net worths, we had family offices asking us for a solution for private markets. So that's the cornerstone of the business. Secondly, we wanted to become market leaders in terms of use of distributed ledger technology, because we do think that that is the way financial markets are going. And we do think that distributed ledger technology will deliver profound or significant efficiencies to financial markets over the coming years. But really, when you think about our core business, and this is how it comes into context with our core business, how does it connect to our core business? Well, our core business today, as you heard from Tony, executes and transacts for a very large number of clients. We are a systemic asset across financial markets in Australia. We underpin large stockbrokers, fintechs, large platform groups, and we do that in what I would call a relatively inefficient marketplace, one that needs large amounts of capital to support it, and one that then requires us to hold that capital and have large lines of liquidity. What distributed ledger technology can deliver are efficiencies from both liquidity and capital perspectives. So the capability for us to use this technology across the back end of our traditional business is a very real one, and is the final piece for us that we'll be exploring over the coming year or two, given that the ASX CHESS replacement, which will be not delivering anything particularly innovative, is still 6, 7, or 8 years away. So that opportunity is very real and something that we're very excited about. There'll no doubt, or hopefully, be some questions on that on the back end. So look, we're going to move to questions now and wrap this up. But just to sort of close out, our core business is very well capitalised, as Tony said. We have cash balances of over 70 million, and further liquidity facilities with our banking partner ANZ, 30 million, and intraday facilities of 130 million. In terms of the current market volumes, our business is overcapitalised. But obviously, in expectations, markets are cyclical, and in expectation that volumes will return, we do think it's prudent to retain this level of capital within our core business. And in actual fact, we're taking measures, as you saw earlier, around A380 to actually release up to $7 million of capital. And finally, market conditions are challenging, but obviously we continue to be disciplined in terms of the costs. We saw that if we've taken costs out in October. A380 will deliver significant cost out benefits, and we're investing in further growth opportunities that leverage our market position. And they're growth opportunities that our clients are asking for, to go back to our clients and increasing our products around cash, around FX, around international and portfolio admin, which we haven't spoken about, but then also on the FCX side, our private markets capability and how that private markets capability then links back into efficiencies across our broader business. So look, I'm happy to go to questions now on any of that. Hopefully many of the questions from some of our shareholders have been answered, but feel free to come through with anything that we haven't answered through this presentation.
Dave, there's a couple of questions on the chat.
Yeah, there's a couple of questions. The first one, because we're very efficient, I have the question and the answer from one of our experts. So the first one is from Giuseppe Bomo, which is around TC. And how's TC been developed over the past 12 months in terms of an IRIS replacement? Have you grown the inward data to at least match the IRIS screen for pricing and information, which was one of the challenges last year? So I've had one of the TC team to come back. I know we have done a lot of work on TC. We've done a lot of work on performance and improvement, stability, and the user interface. We invested a lot into the CBOE tech migration, which was a really big deal for anyone who had an OMS like us. And that was an industry shift. And yes, those data enhancements and other ones are in the roadmap for 24. So there's a lot of work going on in TC. And I think, Giuseppe, I think you're at a scale. We'll probably coming to see you soon to talk about that.
Yeah, so there has been a lot of development done in TC, and that goes to the demand from our clients. We are getting demand from our clients almost on a weekly basis now. I think it's fair to say, you know, there's no love lost in terms of IRIS and relationships and their charging schedule. And the dynamic that I see here in the market at the moment, I personally find a quite interesting one. You know, when markets are very robust and everyone's making money, in particular our brokers, they don't tend to focus themselves on where they can save money. But when you see markets that are depressed and brokers looking for cost saves, then we're actually seeing, as we are at the moment, more demand for more efficient products and services. So from my perspective, you know, while our revenue has taken a hit through lower market volumes, we are seeing more demand for our products and services, which to me is very gratifying.
Pretty good. The second one from Hugh Smith, which is, how long do you expect it to take the Tier 2 market license to be approved once lodged?
Yeah. So we are in constant engagement with the regulators, and I just explained the situation here. They're dual regulators here. I think I explained the situation around the market license and clearing and settlement. But if you put this in the ASX context, market licenses are issued and approved and regulated by ASIC. Clearing and settlement license are issued, approved and regulated by the RBA. The fact that we are applying now for what I'd call a consolidated license, where it's a market license that also facilitates clearing and settlement through atomic transactions, we're entering into a little bit of a new realm, and we are, you know, we are real pioneers in this space. But our engagement is very good from both ASIC and RBA. And the most recent engagement we had is asking them our expectation around being in a licensed market position by the end of Q1 next year. Is that a reasonable assumption? And their reply is, you know, they hate to be tied down on these things, but you know, that sounds reasonable. Whether you'll actually get there by end of Q1 or shortly into Q2, you know, we wouldn't be able to tell you. But certainly we're not getting pushback, huge pushback on that timeline.
Okay, thanks, David. There's a third question here, which is from me, from Chris Fellows, which is, does the share-based payments in FY23, is that indicative of future years? Yes and no. Yes, the share-based payments will continue to be fairly high in 24, although not as high as it was this year, probably closer to 3 million. Now, the background to share-based payments is When we took over the Pershing business, we increased our staff base considerably as a result of that acquisition. And one of our stated aim was that all of our employees would be shareholders in the business. To do that, we issued ESOP to a large amount of people, which would have been issued at a strike price at of $15, which was the last price we raised at. So that results in quite a large share-based payment expense, which is amortized over 3 years. So this year is the peak. It will still be high, but not as high next year, and then should be nothing else changing, a lot lower in future years.
And that's something as well. I've got board online as well, but it's something that we debate at the board level. Obviously, when we started the business, we were very firm proponents of our staff being shareholders, because we believe that drives better results for the business, having that alignment between staff and being shareholders. As the business matures, we continue to I guess debate that, but at the moment we have a policy that new staff coming on board, once they've reached probation periods, will get a minimum what we call share option Class A award.
That's all the questions I have at the moment.
Okay. Happy to take questions over the line, over the microphone, if anyone wants to speak up. If there are any further questions, I can see one of my very, very early founding shareholders with his hand up. Thank you, Paul.
Thank you, David. David, a couple of questions. Firstly, on Project A380, do you foresee any pushback from some of your clients? And how are you going to deal with that, if any?
Thanks, Paul. And actually, and I don't say this lightly, a fantastic question. And one we debated a lot. In actual fact, Paul, and you'll get this because for those that don't know, Paul is a FinClear shareholder, but also a director at Shaw & Partners. Shaw & Partners is one of our very key clients. And in actual fact, it's a good news story for Shaw & Partners and other clients sitting on what we call our TPC platform, which is our third-party clearing platform. Because what we have decided to do is consolidate our business not into our own technology back end, being iBroker, but into a third-party vendor solution that we use for our third-party clients, and that is Broadridge Summit. So in actual fact, for our very large clients, our third-party clearing clients, and they are, just to name a few off the top of my head, obviously Shaw & Partners, but Ord Minnett, Canaccord, Evans & Partners, Wilsons, to name some of the largest, they will be completely not impacted by this at all. There is no change for them at all. So they will remain on current infrastructure. It's our execution clients that will have a change. So what we're doing is moving our execution clients, but we're moving them from where we have, I mentioned before, we were getting a capital relief, and that's because we actually run two clearing firms. One clearing firm that clears for the third-party clients and another clearing firm that clears for our own execution business, and that's FinX, and that entity is FinClear. So what we're actually doing is moving clearing for our execution clients into a third-party relationship and consolidating that, and that lets us retire that clearing counterpart that was clearing just for FinX or our execution business. Look, it's a reasonable migration for those clients, but it's not a large, impactful piece for those clients. Really, all that's happening is if you're an execution client, you're an execution client. you come through and the back end is cleared by FinClear Proprietary Limited using iBroker. In the future, when we move to A380, clearing for FinX will move over to being cleared by FinClear Services using Broadridge Summit. And that will happen around March, April next year. So impact for some of our execution clients, Paul, we hope it won't be large. We have a very large project underway at the moment to reduce as much as we can impact on any of our execution clients. But it's actually a very good story for our third-party clearing clients because they remain completely unimpacted by this.
Paul, listen, when we acquired, obviously, Pershing, we learned a lot about how to communicate and talk with clients. Obviously, that it's not the same, moving clearers, but when we acquired that business, we had to engage, we had to work with clients. So out of that experience, we've got obviously a lot of inbuilt knowledge about how to do that, and we'll deploy that same type of relationship management. I think that's really key. So that's the way that the board was very keen to consolidate, take costs out, and to bite the bullet. We just can't wait for the ASX, but we also need to make sure that, as David said, that we keep a focus on the clients with little disruption, and we got comfortable by thinking about what we've done previously. So hopefully that gives you an understanding.
Yeah, thanks, David, and thanks, Dave. That's great. My other question was regarding FCX. I mean, you've onboarded roughly 30, maybe 50 in the process of being onboarded. At what point do you think you start breaking even as a platform? Is it 100 companies? Is it 75? Do you have a sense of where you need to get to and before it starts sort of generating returns?
Yeah.
Obviously a good question, David. But sorry, Paul, but we don't think of it really in terms of number of companies on platform. We think of it more from a transactional perspective. The companies on platform and providing that registry capability is sort of the front door to get obviously as many companies as we'd like in there. But it's also important to focus on companies that we think will be actually doing transactions on platform. And that's the real driver of revenue for us. The registry services and coming on board FCX is a very moderate fee. Depending on the size of the company, it can be $50 to $500 per month for that registry service and to tokenize securities. Transactionally, we've modelled the transactions, the size that we need to get. And Tony, I mean, why don't you give some insights, because we have a sort of a budget that we've or a projection that we've put together. And we do need to get to some sort of size, critical mass.
Yeah, as David says, I mean, there's, I was going to say two-tier, but it's more than two-tier. There are different revenue flows in FCX. There's the capital registry bit, which is around getting companies on board, investors on board to basically create that market and community for FCX. But that's not really the revenue opportunity. The revenue opportunity is more in capital and liquidity raising and charging a percentage on each, potentially on each side or one side of those transactions. So, for example, if you were to have, you would be looking to have, let's say, about $100 million, which was being transacted a year on the platform, and you charge, and I'm not sure this is the price, and you charge 2% on that. Well, that would be $2 million. So that's where the revenue comes from in FCX, as opposed to lots of companies paying $500 or whatever the number is a month for registry services.
Yeah, and Paul, maybe a bit more sort of granular detail on that. We think that the immediately addressable market for that is well in excess of $1 billion of transactions. Well in excess, and we think that we can address that market very quickly once we go live. So the revenue opportunity is very real and very large. And much of it is driven also by, obviously the need for these corporates to have liquidity events, but also driven by underlying, staff shareholders ESOP awards as well. So, we've been focusing particularly on the ESOP component. We've built out and just delivered an ESOP component within FCX to service those corporates. And we think that those liquidity events then could be a very large driver of revenue.
Thanks, Tony. Thanks, David. Yeah, I totally agree. I think, I guess from my point of view, there's to some degree, it's a bit of a land grab, isn't it? You've got to get as many companies on the platform, then help them transact once you get your license through. So it's, but look, I think there's a big opportunity.
And obviously that forms huge value. There's been, we really have to go from development now to execution about revenue. And really that's the position that we're now in. So, you've got to pivot the company very much to being very much sales driven now and focus around that. So whilst we've got obviously development that we're doing, it's very much about the commercialization of this opportunity and the market license.
Yeah, agreed.
Okay.
Well, thank you for that, guys.
All right, we've got time for a few more questions.
Sorry, we got 3 more questions. 2 of them I'm going to group together for you.
Yeah. Just to follow on our discussion on FCX, how do you propose to create liquidity for private companies? Like, are you going to match the seller and the buyer at the time, or how are you going to do that?
Okay, thanks, Giuseppe. Look, it's what we call a liquidity on demand facility. So it's up to the corporate to determine when they want a liquidity event. So, for example, FinClear, and we're hoping that when the market is live, that we might actually do one of the first liquidity events. But we would only do a liquidity event when we knew that there was, demand on both sides. There were both buyers and sellers. So it's up to the corporate to determine that. They may set regular dates. They might say, well, twice a year or 4 times a year, or we want to do a liquidity event next week because we've been approached by buyers that are interested in the company, and we know that there are staff, for example, to go to ESOP before that might want to sell out and have a liquidity event. So it will really be determined by the corporate when they want that liquidity event. And that goes to the key point of difference between FCX and the ASX, and why companies would want to come on to FCX. It's not a continuously traded market, so you're not subject to continuous disclosure requirements and all the regulatory requirements that go with it. It comes down to the corporate then being more in power of their position, cleansing the market. So putting out a statement saying we're going to put our financial results out tomorrow, and we're going to have a liquidity event next week. Books will open at 9 a.m. on Tuesday morning. They'll close at 5 p.m. on Wednesday. It will be a price auction process. And off it goes. That's the way that we see the market working at the moment.
Thank you. And you'll maintain the registry then as well for those private companies, will you?
Yeah, well, that's right, Giuseppe, and that's a key point of difference, and that's what lets us run. And thanks for that intro, because it lets me talk to my, one of my pet stories, which is atomic transactions and why we are different to the ASX. Once you have tokenized securities, once you are the registry, once you have cash on platform, and we have a cash facility, so we have our own stable coin, if you want to think it that way, where clients can put cash on platform. Once you're able to lock securities and lock cash, you have a market transaction that happens, but at the same time, atomically, in real time, it transacts cash and securities. So there's no longer a concept of T+2 or even T+1, this gap between a market transaction and clearing and settlement. It all happens at the same time. That can only happen if you are able to lock those securities, so you are you are the registry and you're able to lock that cash on platform as well. It's a key differentiation, and it's the key efficiency that FCX delivers over other exchange capabilities.
Hugh Smith's asked, for shareholders wanting liquidity in the FinClear shareholding, when can we expect a secondary market to be opened up?
Yeah, look, we would like to open up we've always been our own first customer. We were our own first customer for clearing and settlement. We were our own first customer for FCX in terms of registry and tokenizing our security, and all our shareholders who want a digital wallet are now able to go online and put their securities and tokenize those securities in a digital wallet. And I hope to be one of our own first client for the market capability. When that happens, March, April, May next year, we would like to think that we could be the first company with a liquidity event.
Yeah, and one more question, 1 minute to go, I'd like to answer from John McMurtry. John's asked, what's the revenue and EBITDA looking like for the first 4 months of this year? But John, I can tell you, look, the market is still pretty depressed as it was before, but we are seeing some small signs of encouragement in the revenue, so the run rate is a little bit better, although not massively materially. On the cost side, we've mentioned 2 things. We did an exercise in October, which has taken $3 million out of the business, so we will see a cost saving come through from November, and post A380 we will see another significant cost saving. So post A380 towards the end of the financial year, we expect the run rate to be much improved in terms of EBITDA. That's all I've got.
All right, we're pretty much on time for an hour anyway. If there are no further questions, I'm happy to pause for a few seconds there. Otherwise, Chair, Mr. Hancock, I'll sign out, say thank you all. Great to see you all online. Hope to catch up with many of you in person, shareholders, over the Christmas New Year. If I don't, please have a happy, prosperous, hope you get some time out over Christmas and New Year, and all the best to yourself and family. David.
Yeah, thanks, David. Yeah, and I think it'd be remiss not to thank the staff and obviously the executives. So on behalf of the board, thank you, and obviously the shareholders for your patience. And, we look forward to showing you further progress over the next period.
Okay, thank you all.
Thanks.
Thank you.